Hello, everyone. This is Ted Bauman here with your Friday YouTube video from Bauman Daily. We had a interesting discussion on Monday this week about the likely impact of the Fed's decision to really stop targeting inflation per se, but rather to target unemployment directly, if you like, rather than try to keep inflation under a certain level. Now, let's go back a bit on this one because I think this is a very interesting topic, and I think it ties into something that has been that I talked about a couple of weeks back, which is the relationship between firms that don't employ much labor and those that do, and what that means for the U.S. economy. So let's take one step back. Let's look at something called the Phillips Curve. I'm going to call this up right here. The Phillips Curve is essentially an identity that a New Zealand economist came up with back in the 50s that says the higher the unemployment rate, or rather the lower the unemployment rate, the higher inflation is likely to be. By contrast, if inflation falls very low, that usually is associated with a high level of unemployment. Now, why would that be the case? Well, in traditional economies in the mid 20th century, the tendency was, of course, to have large labor forces. It was a time after World War II, in particular, when people were building machines, cars, home appliances. They were building things that required physical labor. Automation had not yet become a major factor in manufacturing. And as a result, when labor got tight, it was difficult for manufacturers to continue to pass on labor cost increases to their customers without raising their prices. They had to, in a sense, pass on those increases to their customers. Over time, of course, productivity does increase, and it means that even if wages increase, people will not see rising prices for goods as long as the two move in tandem. If the cost of labor rises faster than productivity, then you get inflation in the end unit, the end goods market. That was essentially the argument. Now, the reason why this is so important is because in the 1970s, a lot of policymakers felt that one of the big drivers of inflation was that there was too much power on the part of labor in the US labor market. And as a result, the built-in increases in wages that went to unionized labor, particularly in manufacturing, were leading to increases in inflation. And that one of the ways to tap that down was to raise interest rates in order to discourage people, if you like, from buying goods, right? And if they weren't buying goods, that meant that workers could not press for higher wages. That meant that you could actually derail the inflation train and move yourself to a part of the Phillips curve where the inflation rate was lower, even if unemployment was higher. Now, what's happened since then, very strikingly, since the 1980s, the Phillips curve, particularly in the 90s and 2000s and the last decade, does not appear to work the way it used to do. It used to be that when you saw very, very low inflation, you'd start to see, or sorry, unemployment, you would see inflation tick up. Nowadays, we don't see that. We haven't seen inflation over 3% in quite a long time. I think it's been more than a decade that we've seen inflation over 3%. And at some point last year, I think we were actually flirting with a 3% unemployment rate, which, as you might have noticed from the chart I showed you earlier, used to correspond to an inflation rate of about 5%. So here's why that's important. The Fed used to operate on the basis that if the unemployment rate fell too low, even before inflation started, they would start raising rates. And that's what they did in the mid 2000s. We saw a couple of times when the Fed began to raise rates around 2016. They did it again in late 2018. They started talking about raising rates. And the result was that the stock market began to tank because they were worried that raising rates would make bonds more attractive, and that would take some of the buying power away from the stock market. That's the way things used to work. What's happened now is that the Fed has said, look, it's pointless for us to raise rates before the inflation rate actually begins to rise. And here we're talking about the broad consumer inflation rate. Any given amount or any given sector of goods may be rising in price faster or lower than the broad rate. The broad rate is based on a statistical basket of goods. So let's not get into an argument about whether gas is going up or groceries or whatever. That's not the way it works. The critical thing is that the Fed has now said we will not start raising rates until we actually see inflation start happening. Now, the big question is, will we get inflation if we get very low unemployment? Will we get very low unemployment? And this is where I want to go back to first the video that we had on Monday and the one that I spoke about a couple of weeks ago. First, let's talk about whether we'll get inflation. My argument is that lowering the interest rate in this current environment doesn't do much for new business investment. Lowering the interest rate does not encourage new employment because most of the kinds of investments people are making these days are not related to physical goods and services. In fact, they're not related to employment at all. They are related to technology and things that involve intangible intellectual property, like computer code, algorithms, et cetera, brand names. If that's the case, then lowering interest rates doesn't really do anything in terms of causing more inflation because it doesn't result in hiring workers. Even in or in industries that do use a lot of physical labor, the rule of thumb is that the companies will have a hurdle rate, that they will set an internal hurdle rate and say that unless we can make an X amount of return on an investment, we won't do it, right? And that hurdle rate is not really related to the actual rate of interest. That's particularly true when you get situations like we have now where the cost of corporate credit is incredibly cheap. Really, the main obstacle to investment is not whether capital is cheap, but whether there is an actual viable end market for the goods that you want to sell. This takes us back to the whole question of Keynesianism and whether people have enough money to buy things. Here's why I think that's an important thing to consider. Let's look at a couple of charts that I showed in a video a couple of weeks ago. This first one shows the sources of federal revenue going back to 1950. As you can see very clearly, one of the biggest changes is that corporate income tax has fallen as a percentage of federal tax receipts, and the percentage of payroll taxes, things like Medicare and Social Security, have risen very substantially. Here's the reason for that. Essentially, what we've seen is that from 1950 until 1990, the payroll tax rate, which is basically what your employer pays on your behalf when you are an employee and you pay half of it, has risen from about 3.5%, 4% to around 15% of the effective tax rate that corporations are paying. Whereas the effective corporate tax rate has fallen from over 40% to down to around a little bit over 5%. Now, remember, effective tax rates take into account all the loopholes and all the tax shenanigans that companies can get away with. Now, why is that important? Well, if you look at the chart, you can see that effectively it means that you pay less taxes the more capital you use and the less labor that you use. So here's the next chart that illustrates what that means in practice. The blue line at the bottom shows the number of employees in the heavy technology sector, the so-called FANGs and so on, per 10 million of market capitalization. It kind of figures around two, so for every $10 million in market capitalization, those big tech firms like Facebook, Google, Apple they have a little bit more than 2 employees involved. But look at the S&P as a whole. Back in 2012, it was over 16 employers or employees per $10 million in market cap, but it has fallen substantially since then to the point where it is now below 10. Now, what does that mean for us in practice? What does it mean for the economy? What it means is that there is a strong incentive not to employ labor, but rather to invest your capital in the kinds of business operations that hire as few people as possible, but attract big returns to capital. What does that mean? Well, here's a chart that shows why, or what it means. And this came up in Bloomberg today. It's a chart that shows the performance of companies basically this year for companies based on how much the value of intangible assets per employee are. So basically companies that are in the top tier, the top 10%, the top decile, in terms of the amount of intangible assets per employee are the ones that have earned the bulk of the rewards. Another big chunk in the second decile going down to the third decile. Essentially what this means is that all those big companies with huge investments in technology, but very few employees relative to the size of the company are the ones making all the money. If you go down further, you can see that it just gets worse as you go down. The actual bottom, in other words, the companies that employ the highest number of laborers and have the fewest total amount of intangible capital are the ones that are doing the worst. So in a sense, what's happened is that the firms that rely least on employees to make money have beaten the firms that rely most on employees to make money by 37 percentage points this year. Right now, the five largest companies in the S&P 500 account for 5% of the index's overall workforce, just 5%. That was 10% 20 years ago. Now, what does that mean in practice for the economy? Well, here is a chart I showed a while back that tells you really, as time has gone by, the median male income in the United States of an individual male worker no longer pays the bills. It cannot keep up with the rising cost of housing, healthcare in particular, college also contributing a big chunk of that. My point is that what we're seeing in this pandemic year is a bear market for humans, basically, as a guy said, the director of macro strategy at the StoneX Group, Vincent Deloard, used that term. He said, basically, what we have is a bear market for human beings. Now, here's the interesting thing, and this ties back to, I think, what we've been discussing all year. I know that at the beginning of this year, I felt that the stock market was not going to be able to sustain its rise, and I was wrong. And I feel like part of the reason for that is because I was expecting the stock market and the economy to behave in ways that it has in the past. As an economist, as an economic historian, that's where I look to for guidance in the first instance. But we're entering a new paradigm. We're entering a paradigm where essentially the companies that make money are the companies that employ the least possible number of people. Now, what that means is that the rebound in the economy that we've seen during the summer this year is due almost entirely, really, on the government payouts that came out. A lot of people object to them, say we shouldn't be making them. But I guarantee you, if we weren't making them, the fact that the companies that employ people are the ones that are suffering the most would have had a devastating impact. This is one of the reasons why I and others have said that the failure to pass a stimulus bill going forward would actually lead to another downturn in the economy. Whether that causes stocks to go downturn is another question. Given what I've just showed you, it's entirely likely that they won't. What it does show, though, is that the only companies that will benefit are those that use intangible assets. Now, the problem with this is that ultimately, even companies that are based on intangible assets like technology, the Facebooks, the Googles, the Apples, et cetera, even they have to sell their products ultimately to customers. A company like Facebook, for example, makes almost all of its money through advertising. If the companies that advertise on Facebook are doing poorly because people in the economy can't get jobs that pay, because the real economy is faltering, then eventually this has to fade through to these companies. So my bearishness, if you want to call it that, really comes back to this long-term perspective. Yes, this year the technology sector has gone gangbusters. I've just showed you why, because the market is rewarding companies that make more money by using lots of capital than using lots of labor. Technology and particularly intangible capital is the best kind of capital you can have. You pay the lowest rate of tax on that. You pay more tax on that to hire labor. So my point is that we are kind of building ourselves into a trap here, where eventually, somehow, this has to give. You cannot continue to have an economy where a number of very, very large companies have huge market capitalizations, but ultimately the ultimate source of end user demand for even their goods and services is evaporating because people are not making enough money. I would appeal to you, think about this. Think about it when you make your investments. Yep, you're making money on the short term on Teslas. In the long term, Tesla has to sell its products to a lot more people. If they can't afford it, what are Tesla's stockholders going to experience? Hard to tell, but it doesn't look good in structural terms in long term. I know in the short term, we're all traders, but in the long term, we have to take these things into account. Anyway, that's me, Ted Bauman, for this week. I'll be back next week. I would encourage you, if you're interested, to have a look at my Alpha Stock Alert service. It is now beating the market by about 4-1 on open positions. We're doing extremely well this year. I know a lot of you assume that I'm doing that by shorting and by convincing others to sell stocks, but that's not the way we're doing it. We don't short, we don't sell options. We basically, or buy options, we basically just invest in companies that are doing well. Anyway, that's enough for me. I'll talk to you next week. And next week, I promise I will have my final guitar. I finally got around to fixing it.